Hey everyone, welcome back to Corporate Decoder. Today we're diving into a big money move by Keurig Dr Pepper Incorporated. And let's just say they're not messing around when it comes to their beverage game. So buckle up because this report might just serve you a tall glass of, well, debt before we dive in. If you're tired of corporate jargon and want the real story behind these filings, make sure you hit that subscribe button. And hey, we've got a fantastic Discord community where we break down these reports in real time. So join us there using the link in the description below. So we've got Keurig Dr Pepper Incorporated KDP for short, filing an 8K. This is generally a report of big important events that shareholders need to know about pretty quickly. And usually it means something significant has happened. The main event here is KDP signing a massive term loan agreement. Think of it as taking out a really big loan, a 364-day loan, just shy of a whole year. To be exact, they're lining up to borrow up to a whopping 10.35 billion. That's a lot of euros, folks. To put that in perspective, that is enough money to buy a small island, or more realistically, fund a pretty significant business expansion or acquisition. This loan isn't just a simple handshake, it's with a bunch of lenders, and Morgan Stanley Senior Funding Incorporated is acting as the main agent managing the deal. For KDP to get this money, they have to meet certain conditions. It's like qualifying for a mortgage, but on a corporate scale. Now, how much will this cost them? Well, the interest rate is tied to something called the Euribor rate, which is a benchmark interest rate for euros plus a margin. This margin can range from 0.750% to 1.750%. What determines this range is based on KDP's credit rating. If their credit looks solid, they get a lower margin. If it's a bit shaky, they pay more. Even the money they don't borrow from this facility but have committed to the bank costs them a fee. Starting the 23rd of December, Supro Daisu pay a commitment fee that can range from 0.060% to 0.200% annually, again depending on their credit rating. Plus, a bunch of KDP's subsidiaries are guaranteeing this loan, meaning they're on the hook if KDP can't pay it back. This isn't just a loan they can ignore. The agreement includes clauses that will force them to either pay back some of the loan or reduce the available credit whenever they make certain big asset sales, or when they raise money through other debt or stock offerings. This basically means they're aiming to use this loan for a specific purpose and will pay it down as other funding becomes available. The agreement itself is pretty standard for companies with good credit ratings. It includes all the usual promises about how KDP will operate. There are rules about what KDP and its subsidiaries can and cannot do, like taking on more debt or making major changes to the company, all with some exceptions. Of course, they also have to maintain specific financial ratios. One is a minimum interest coverage ratio of 3.25 to 1.0, meaning they need to earn at least 3.25 times what they spend on interest. This kicks in after they actually start borrowing the money. Another is a maximum total net leverage ratio of 6.25 to 1.0, but this only applies if their credit rating drops. So they've got some breathing room, but they need to keep their financial health in check. And here is the big reveal. The primary purpose of this massive loan is to help fund the acquisition of JDE Peet's. This is a major acquisition, and this loan is clearly a big part of the financing strategy. They also mentioned they could use other financing methods, but this term loan is a key part of their plan. But wait, to read more. On the same day, the 18th of December SUP 2025, KDP also made changes to another loan agreement called the Bridge Credit Agreement, which they'd already set up. This amendment significantly reduces the amount available under that existing bridge loan. It's being cut by 10.35 billion, bringing the total available down from 16.2 billion to 5.85 billion. This makes perfect sense because they just secured that 10.35 billion term loan. They're essentially shuffling their funding sources using the new loan and reducing the old one. It also looks like they've adjusted the rules so that if they bring in money from other sources, it will first go towards paying off the new term loan and then the bridge loan. So to recap the financial part, KDP has created a huge new debt obligation with this term loan, and they've adjusted an existing one. This is a massive financial move, signaling a major strategic play, likely the JDE Peet's acquisition we mentioned. This term loan agreement from the 18th of December SUP 2025 is the big one we've been talking about, and this is the amendment number. One to the Bridge Credit Agreement, also from the 18th of December, SUP 2025, showing how they're tweaking their borrowing plans. And finally, signing off on all this is Anthony Shoemaker, the Chief Legal Officer, General Counsel, and Secretary for Keurig Dr Pepper Incorporated. Now, let's cut through the legal speak. What does this all mean? KDP is borrowing over 10 billion. That's a monumental amount of money. And it's clearly tied to a huge acquisition, the purchase of JDE Peet's. This tells us they are aggressively pursuing growth and are willing to take on significant debt to do it. The fact that they are reducing their bridge loan while taking on this new term loan suggests they have more confidence in the new loan's terms, or certainty of funding for the acquisition. However, taking on so much debt is not without risks. Interest rates can rise, and if the acquired business or KDP's overall performance doesn't meet expectations, servicing this debt could become a major burden. Their ability to maintain good credit ratings will be crucial to keep their borrowing costs manageable. We'll be watching closely to see how this acquisition plays out, and if KDP can successfully integrate JDE Peet's and generate sufficient returns to justify this large financial commitment. The company's direction is clearly focused on aggressive expansion, but the execution and economic climate will determine its success. The key risk here is the integration of JDE Peet's and the potential for unforeseen challenges in the highly competitive beverage market. It's a bold move, and we'll see if it pays off. Alright, that's our breakdown of Keurig Dr Pepper Incorporated's latest filing. What's your take on these massive borrowing plans? Do you think this acquisition is a smart move or a risky bet? Drop your thoughts in the comments below. If you found this analysis valuable, give this video a thumbs up. It really helps us out. And subscribe for more corporate deep dives like this one. And don't forget to join our Discord community, link in the description, for more real-time insights and discussions. Thanks for watching, and we'll see you next time.